Hey everybody, Chris Lamm. This is a market update for the month of October. We're going to go over a lot because there's a lot going on right now. Now, a lot of people are concerned about the economy and certainly the housing market. Interest rates have more than doubled since the beginning of the year. We're going to jump into not only what's happening now, but what we think could happen over the next year. So the first slide that I thought would be helpful is I want to show you guys the correlation between inflation, which is the white line, and 30-year mortgage rates since the 70s. Now, the first thing I want to note is inflation currently is at the highest point that it's been since the 70s. But the second thing that's really interesting is that any time inflation has gone up in history, if you look at these dark blue bars, these represent every recession we've had since the 70s. The most recent one obviously being the short one we had during the pandemic, followed by the Great Recession of 2008, which was the longest one in a long time. Now, the other thing I want you to look at is this. Anytime inflation has gone up, the Fed has stepped in, raised rates, and inflation has always come back down. And anytime inflation has gone up, if you look at the blue line, mortgage rates have gone up with it. Now, the Fed rate is not directly tied to mortgage rates, but mortgage rates have been correlated with inflation over time. So if we go to our current time frame, you'll see on this side here that inflation is going up, mortgage rates have gone up with it, okay? But what this really shows you here is that when inflation comes down, mortgage rates will come down too. The next slide I want to show you is very similar. This white line here is mortgage rates, okay? And then the yellow line is a recession. Anytime we've ever been in a recession, usually it starts with higher mortgage rates, but invariably it has always ended with lower mortgage rates. All right, so we want to kind of show you another slide here. Now, the second thing we're going to talk about is inventory. A lot of people are concerned that we're going to have a housing crash. In fact, housing is softening nationwide. Here in Shasta County, prices have come down a little bit. Buyers are coming to the table with higher mortgage rates, but they're getting a deal on a house that they haven't seen in a long time. And this is one of the reasons why we don't believe home prices are going to crash. If we go back to 2007, which was the peak of the housing market, there was 3.8 million homes for sale. If we go to our current time frame, there's currently around 1 million homes for sale nationwide. The one thing that you want to note is if we compare 2007 to 2022, as I showed you in the last slide, there was 3.8 million homes for sale in 07. There's 1 million homes for sale today. There's 129 million households in America, which is 14 million more households that need to buy a house. And I've talked to a lot of builders around the nation, including one in the Northwest that builds thousands of homes, and they are all slowing down production, which means there's not going to be enough inventory to meet that demand of the households that need to rent a house or buy a house, which is going to continue to put pressure on prices and probably keep us from falling too far. A lot of people are seeing prices going down. I'm not saying that's not going to happen. I'm just saying if we look at 2008, we cannot compare that to 2022. The next slide I wanted to show you, just to kind of emphasize this, is that new rents are up double digits, renewals up on average 8%, and this increase will continue. Here in California, the average rate of rent increase is about 6% a year. The last 2 years it was higher than that, which means if you rent a house today, that rent is going to cost you twice as much in 9 years. So even with rates being higher, most people see the benefit of locking in a payment and knowing that they have a hedge against the inflation of the rise in rents that we're going to continue to see. The forecast. There's less demand in 2021 due to higher rates and prices. I actually meant 2022 here, but it's still a very strong market. The demand has not gone anywhere. People need housing. They just don't love that rates are higher right now. So we're going to talk more about that. Inventory is still pretty tight. We have around 700 homes for sale in Shasta County. A normal market's about 1,200 homes. Every other market around the nation is seeing similar trends. Some are going to be a little bit different. Places like Boise and Austin, where there was a lot of migration over the last few years, they saw a lot higher push in values. They're probably going to see a little bit of a lower decline, but there's stable markets like Reading where we're going to see this trend continue. The vacancy rates for housing right now. This graph shows from 1968 through current where we're at for vacancies. They are simply at an all-time low. Most property managers will tell you that they are seeing a little bit less demand, but they still have way more demand than they have rentals available, which is what is putting so much pressure on the rental market. I want to show you a couple slides here. This is some of the headlines that we're seeing right now. Our government is not calling this current market a recession, but the definition of a recession is 2 consecutive quarters of no growth in our GDP or negative growth, which we currently have, although they're not calling that yet. But most of the CEOs of large companies, hedge fund managers, are saying we are in a recession now, and we will probably call it that officially by the first quarter of next year. This isn't to fear monger, it's just telling you what's actually going on. If you go back to the first few slides, that is why we're so bullish on rates coming back down next year. Another slide that I think is very important is that Fannie Mae just came out recently and said that they believe that rates will be at 4.5% or somewhere in that range by this time next year. And I want to touch on that for a second. A lot of people that are buying homes right now, not only are the rates higher, but for the first time in a long time, they're paying points when they lock in their loan. And the reason for that is because the people that we all as mortgage people sell our loans to, Fannie Mae, Freddie Mac, Ginnie Mae, and many others, they know that people are not going to be paying on these loans for much longer than a year, maybe a little longer. And so the way that mortgage investors make money is they make money on that interest over time. Well, if they think that these loans are going to be refinanced, they're going to charge points up front to try to claim some of that profit on the front end of the loan. So I just wanted to explain some of the trends we're seeing right now. One of the last slides I want to share with you that I really think paints a picture as to why we're not going to see the crash that a lot of the media is talking about is 37% of the homes in America are owned free and clear. There was so much money pumped into the system over the last 5 years, and all that money is still there. In fact, many of the buyers that are still moving into Redding are paying cash or putting really large down payments because they simply see the value here and what they can get versus what they can get in many other markets in America. So there's something I wanted to share with you. Couple things to remember. This is a saying that's going around a lot right now for people that are still trying to make a decision on whether it's a good time to buy the house. You date the payments, but you marry the house. I would rather buy a house at a lower price like we see today and get a higher rate than buy a house at a higher price with a lower rate like most people have done over the last 4 to 5 years. Even though they probably are still going to do fine, if you can get that house at a lower price because rates are putting pressure on the demand of buyers, you can always refinance that loan, but you can only buy that house once. A few things to remember: it still costs less to buy now. You can get right now, because of what's happening in the market, sellers are becoming much more willing to cooperate with the buyer. In many cases, the buyer is willing to contribute money towards that buyer's closing costs to help them buy their rate down and find an affordable rate for their mortgage. Less cash out of pocket is something that's very common right now because of that scenario. There's more inventory today. There's more homes for sale than there was 6 months ago. In fact, from the beginning of the year to today, there's almost twice as many homes for sale. So buyers that are in the market have less competition and more options. You don't have to waive your contingencies. Last year and the year before, anyone that bought a house, many people were paying above asking price. They were having to make all kinds of sacrifices to get that seller to be willing to let them buy their house. Today, that is simply not the case. It's a much slower pace for buyers to actually be able to look around, see what's available, and make a good decision for them and their family. So that's it. I just wanted to give you some stats of what we're seeing right now. I want to also just say thank you so much for everything you guys have done for us and supporting us. If you're concerned about how this market could have any impact on you, if you have any sort of transition going on in your life, please give me a call anytime. Have a great day.